Investing in stocks versus cryptocurrencies. Are traditional, widely accepted investment vehicles like stocks that different than new digital assets like cryptocurrencies? Are there more or less compelling reasons to invest in stocks versus cryptocurrencies as retail investors? Hello, I'm Crypto Casey, and in this video, we are going to explore how investing in stocks actually shapes up against investing in cryptocurrencies from a valuation and utility standpoint. This video was inspired by a tweet thread by my favorite crypto economist at Tasha Labs, so be sure to give her a follow on Twitter for some great crypto content. Awesome. Let's explore the underlying value of stocks versus cryptocurrencies so we can make better investment decisions for our futures. Before we get started, let's make sure we are all on the same page about a few different concepts. 1. What is an asset? Asset is a fancy finance term that just means something useful or valuable that can be transferred between people or entities. It can be something physical like gold. It can be shares of companies like stocks. It can be something digital like Bitcoin. It can be something abstract like expertise. It can be a financial instrument like a retirement plan. And it can be anything that helps you generate income, like a car, computer, or cell phone, for example. Sweet. Let's explore 3 characteristics of assets that make them more or less valuable over time. 3 qualities of assets. 1. Limited supply. Assets with a limited supply are more valuable than ones with an unlimited supply. Think about real estate. At least in the physical world, it is very limited and becoming price prohibitive for most retail investors. Bitcoin is also an example of an asset with a limited supply of only 21 million that will ever be in circulation. Both of these constitute a better store of value and wealth over time than assets like fiat or cash, whose supply can increase into oblivion as we've seen in the past few years. In addition to goods and services increasing in price from shortages and increased demand, the money we use to buy goods and services is decreasing in purchasing power or becoming less valuable due to its unlimited supply. As for stocks, the amount of shares a company issues, buys back, and similar causes the supply to fluctuate over time. Nice. 2. Durability. Durability of an asset refers to its ability to retain value over time, be transported across space, and exchanged between buyers, sellers, or inheritors. So diamonds are chemically stable and strong, making them physically durable. They have been and continue to be desired by marketplaces because they are attractive in the jewelry industry, which represents a more abstract sense of durability in retaining its value over time. In terms of Bitcoin and other crypto, their transparent and immutable existence on a decentralized blockchain ledger makes the digital assets extremely durable from the standpoint of its ability to exist, because the nature of the blockchain makes it hard to destroy while also making it easy to transport and be exchanged between buyers, sellers, and inheritors. Now, the value of stocks over time is predicated on a few factors, mainly the continued successful existence of a company. As far as being able to transport them, since we never actually have or store the stocks ourselves, you just watch the price exposure through apps like Fidelity or Robinhood. And you can't really send stocks to your family or friends. You can only hold them on the exchange or choose to buy and sell them on the exchange. Quality 3. Social agreement. Social agreement is simply when a substantial amount of people agree something is valuable or has value. Diamonds have formed a ton of social agreement over time due to their durability and desirability. Gold is another example of an asset that has stood the ultimate test of time as a good store of value from a social agreement standpoint, as a hedge against inflation, its use in jewelry, and in technology. In the past several decades, stocks have garnered social agreement as well. In modern times, it's actually extremely difficult for social agreement to form around potential new digital assets like cryptocurrencies, because it requires a near-perfect storm of variables coming together at the right place and the right time. Things like laws, regulations, institutional recognition and adoption, retail recognition and adoption, and psychological phenomena surrounding the new potential asset, as well as trusted technological platforms capable of maintaining the new potential asset. So as social agreement for the original digital asset Bitcoin has formed and solidified over the past decade, it paved a new way for value of new and upcoming digital assets like cryptocurrencies to start gaining social agreement. And of these 3 qualities we covered about asset valuation, social agreement is the most important aspect for cryptocurrencies to garner, grow, and foster from a value perspective. As we will discover throughout this video, social agreement is not always based on an asset's underlying value or utility per se. For example, with the GameStop and AMC fiasco, we saw meme culture form around these particular assets that substantially increase their valuations. In the crypto markets, the same can be said for cryptocurrencies actually based on memes like Dogecoin and Shiba Inu. So memes are a new form of social agreement in both the traditional stock market and cryptocurrency market that represent a large group of people's overall sentiment. Sometimes that sentiment can be based off of figures and calculations, and sometimes that sentiment can represent a social movement like Dogecoin investors' way of sticking it to the man or Wall Street. Social agreement with stocks versus crypto. One of the main traditional valuation techniques that affect stock prices is the stock price times the total amount of company shares that equals the value of the company. Sure, the value of a company can be evaluated by looking at cash flow, balance sheets, assets, liabilities, financial statements, mergers, acquisitions, etc. But at the end of the day, the stock price times the total shares equaling the value of the company is just as arbitrary as something like Dogecoin having a current price times the total amount of tokens equaling an $18 billion market cap. The former is based on old, long-standing social agreement that a simple equation accurately represents the value of a company, while the latter is based on a new network-driven, cultural, and social perspective of the value of digital assets like Dogecoin and Bitcoin. Both are perfectly valid, just as they are perfectly arbitrary. Cool. Next, let's take a look at what owning stocks as an investor looks like versus owning certain cryptocurrencies. Stocks back in the day paid shareholders dividends. So if the company was profitable and doing well, a person that owned their stock benefited from that profitability in the form of dividend payments. During this time, the stock price times total shares equaling a company's value was less arbitrary. However, now companies' dividend payout ratios, as well as companies that distribute a percentage of their earnings to shareholders, have decreased substantially since the 1950s. So why aren't companies paying dividend payments anymore to stockholders? Because they aren't profitable? Because they aren't experiencing success? Actually, quite the opposite. Company profits as a percentage of the entire economy have increased substantially over this time period. Companies like Amazon, who have been wildly successful, have never once paid anything to their investors in their entire 30 years of existence. So basically, if you own one Amazon stock or have a huge bag of Amazon stock, you don't receive any benefits from the company growing and becoming more profitable. In fact, whether Amazon is successful or not, owning their stock doesn't really actually directly affect you. Your stock is merely a representation of your shared ownership in name only. Zero other benefits. Sure, you can buy it, hold it, and sell it, just like any other useless governance cryptocurrency tokens, which begs the question, are stocks and owning stocks any different from certain cryptocurrencies and owning cryptocurrencies? Let's think about it. Amazon doesn't distribute any of its profits to you. Owning the stock is ownership in name only, and the only benefit you get is the opportunity to sell the stock at a higher price if it goes up. So how's this different than owning some Bitcoin or Dogecoin that at the time of this video do not offer any additional investment benefit, like a dividend? Well, in the case of crypto, if you hold it in your own wallet, you actually have possession, ownership, and control over it, not just a representation of ownership like a stock. And if you don't have your own cryptocurrency wallet yet, you can use the links in the description area to access the correct and official sites of my recommended hardware wallets. BC Vault is my personal favorite. Another option are the Ledger devices. So go to the description area to check them out. Cool. Also, in the case of crypto, you get the opportunity to sell it whenever you want, hopefully at a higher price. And guess what? There's much, much more. You can actually borrow against these assets, lend them out for interest payments, stake them for rewards in some cases, qualify for airdrops of pretty much free money, and a lot of other creative things using DeFi or decentralized finance apps and protocols. Can't do that with stocks. You also can't transfer ownership of stocks to anyone around the world at any time for a relatively cheap price. So if you haven't taken the plunge and bought any crypto yet, and you're ready to jump in, you can get $10 worth of Bitcoin for free when you invest $100 or more with Coinbase by clicking on the link in the description area to access the correct and official site, all while supporting the channel. You can also check out my video guide for beginners on how to invest in crypto safely and securely, step by step, by clicking on the link above. Brilliant. So you can see how social agreement around stock ownership and crypto ownership are both pretty much based on both arbitrary logic and illogic. Because any gains you realize from Amazon stock isn't coming from Amazon. It's coming from buyers and sellers in the market that share the same social agreement about valuation and are willing to buy shares from each other at higher price when the company performs well. So if people in the market didn't behave or respond to companies performing well, then the stock price wouldn't go up, even though the stock price times total shares equation is increasingly detached from reality. And in crypto, consider some useless governance tokens. Holding them doesn't give you any real ownership in the project, and they don't pay out yields or dividends. So why does the price not go to zero? It's because people in the crypto market are applying the same socially agreed upon valuation method that people use in the stock market. The arbitrary token price times total supply equaling its value. Unfortunately, a lot of people are just gambling on projects in the crypto market because they don't know how to differentiate a project with potential from one that doesn't in the long term. And any returns or gains they realize come from other people in the market behaving the same way. So why is this concept important to understand as a crypto investor? Well, if we take the time to recognize how buyers and sellers in the market are determining valuations of projects, then we can make better investment decisions in the long term. Instead of sharing the same blind, arbitrary social agreement as other people in the market, like price per token times total supply equals its value, let's adopt a more reliable framework to assess the future value of crypto projects that considers the economic output generated by the cryptocurrency projects. So how do we assess the economic output generated by a cryptocurrency project? Well, I made a simple guide for beginners on how to do just that, specifically for layer 1 and 2 cryptocurrency projects. And you can also apply the same framework to other types of cryptocurrencies. You can check out that guide by clicking on the link above. Nice. So instead of blindly throwing money at projects crypto influencers shill without doing your own research, or instead of blindly adopting the arbitrary token price times total supply equals value of a project, check out that guide to start developing new skills to assess projects and their potential. Even though the collective, blind, arbitrary price times supply equals value method is still the most socially agreed upon method at this time, we will have an edge over the market going forward by paying attention to projects that are generating economic output, creating good profit-sharing structures for token holders within their ecosystems, similar to dividends, and that exhibit other positive performance indicators, like total transactions processed on their networks, volume, velocity, and other measurements we can tie to metrics like total supply to more accurately determine a project's value and viability in the future. Awesome. Thank you so much for taking the time to watch this video. If you enjoyed it, please make sure to like this video and subscribe to my channel for more crypto content. So what do you think about the comparison of stocks versus crypto? Are you going to check out the video guide about how to evaluate projects? If so, which cryptos are you looking to research as potential investments? Let me know in the comments below. Be safe out there.